Most people spend 30 or 40 years building toward retirement. They save, they invest, they track the balance, they watch the number grow. And then, somewhere around 5 years out from their target date, they assume the hard part is basically over. The money is there, the finish line is visible. All that's left is to coast in and collect the reward. That assumption is one of the most expensive mistakes in personal finance. The 5 years before you retire are not the cooldown lap. They are the most financially consequential window of your entire working life. The decisions you make or fail to make in this specific 5-year window will determine whether your retirement income lasts 20 years or runs short in 12. Whether your healthcare costs are manageable or catastrophic, whether your tax bill in year 1 of retirement is $8,000 or $31,000, whether you feel financially free the day you quit or quietly terrified within 18 months, today, I'm giving you the blueprint for those 5 years, step by step, in the order that actually matters. My name is Eric, and I spend way too much time thinking about money, retirement planning, and the specific decisions that separate a retirement that lasts from one that doesn't. If you're within 5 years of your target retirement date, or you know someone who is, subscribe and give this a thumbs up. This one is gonna matter. In the 5 years before you retire, things start to feel real in a new way. This is the window where retirement stops being a distant idea and starts becoming an actual date on the calendar. The focus shifts from general financial planning to more practical, detailed planning. Decisions like when to claim Social Security, how to cover healthcare, and how to turn savings into reliable income start to matter more, and getting them right can make retirement feel a lot more comfortable. Here's what makes this window genuinely different from everything that came before it. For the last 30 years, the primary task was accumulation. Save more, invest consistently, let compounding work. The decisions were relatively forgiving because time absorbed most mistakes. A bad year in the market recovers. A missed contribution gets made up. The margin for error was wide. In the 5 years before retirement, the margin narrows dramatically. You are transitioning from accumulation mode to distribution mode, from building the engine to actually running it. And the sequencing of decisions in this window is everything. A tax-smart withdrawal strategy can add years to portfolio longevity. The wrong Social Security claiming decision costs you tens of thousands over a lifetime. A healthcare gap in the wrong month costs more than a month of mortgage payments. The blueprint that follows is built around the right sequence.
Year 5. Build your real number. 5 years out is not the time to assume your current retirement account balance is enough. It is the time to find out specifically whether it is and to stop guessing. The first task is establishing your retirement budget, targeting 70 to 90% of your pre-retirement income, depending on your mortgage status, healthcare costs, and planned lifestyle. But here is where most people make the critical error. They build the budget using their current spending, not their projected retirement spending. Those are different numbers.
Healthcare will cost more once you're off employer coverage. Travel and hobbies may cost more in the early active years. Housing may cost less if the mortgage is paid off. Run the actual projected budget, month by month, category by category, for what your retirement life will actually look like, not what your current life looks like. Then run the math against your projected income, Social Security at your claiming age, any pension. The 4% withdrawal rule on your investable assets, meaning 4% of your total retirement portfolio, is a sustainable annual withdrawal over a 30-year retirement. Financial professionals now recommend limiting withdrawals to 4% per year to ensure long-term sustainability while accounting for inflation and potential market fluctuations. If the math works, if projected income covers projected expenses with a reasonable buffer, you are on track. If it doesn't, you have 5 years to close the gap. That is enough time to meaningfully change the outcome. It is not enough time to be surprised by the gap at year 1.
Year 4. Rebalance and reduce sequence risk. Here is a risk most pre-retirees have never heard of, and it may be the single most dangerous financial threat in the 5-year window. It is called sequence of returns risk. Here's how it works. If the market drops 30% in your first 2 years of retirement, when your portfolio is at its largest and you are simultaneously withdrawing from it, the damage is permanent in a way that a 30% drop at age 45 simply is not. At 45, you are still contributing, the balance recovers, and the long-term outcome is fine.
At 63, taking withdrawals from a portfolio that just dropped 30%, you are locking in losses and depleting principal simultaneously. Recoveries that took 3 years at 45 can take a decade at 63, and the math of portfolio survival changes drastically. 4 years out, the task is reviewing your investment mix, rebalancing to reduce volatility while maintaining growth. This does not mean moving everything to bonds and cash. It means building what planners call a bucket strategy. Typically 1 to 2 years of living expenses in cash or near cash, 3 to 5 years of expenses in conservative fixed income, and the remainder in diversified equities for long-term growth.
This structure means a market downturn in year 1 of retirement does not force you to sell equities at depressed prices to cover living expenses. You draw from the cash bucket. The equity bucket recovers. The sequence risk is neutralized. Do you have 12 to 24 months of withdrawals set aside in low-risk accounts? Protecting liquidity in a high inflation or unstable market environment is one of the most important steps you can take. The answer to that question, 4 years before retirement, should be yes, or building rapidly toward yes.
Year 3. Map every income source and the tax bomb. 3 years out is when the income architecture of your retirement needs to become completely explicit. Not approximate, but specific to the dollar. Your focus should shift from accumulation to distribution mode, mapping exactly how each income source will work together to create a reliable monthly retirement paycheck, including Social Security, pensions, annuities, and investment withdrawals. Every source has a start date, a tax treatment, and a sequencing implication. Social Security, taxable, delayed by 4 years from 62 to 70, can increase the monthly benefit by up to 76%. Traditional 401k and IRA withdrawals, taxed as ordinary income. Roth IRA withdrawals, completely tax-free. After-tax brokerage accounts, taxed only on gains at capital gains rates. The order in which you draw from these accounts in your early retirement years determines your effective tax rate for potentially decades.
Here is the tax bomb most people walk straight into. If you retire at 62 and wait until 70 to claim Social Security, which maximizes your lifetime benefit, you have 8 years where your income is low and your tax bracket is low. A tax-smart withdrawal strategy can add years to portfolio longevity. A year-by-year Roth conversion and tax review is essential. Those 8 low-income years are the single best window to do Roth conversions, moving money from your traditional IRA into a Roth IRA at a low tax rate so that all future growth is tax-free and your required minimum distributions at age 73 are dramatically reduced.
The current average Social Security benefit is $2,071 per month. The RMD age is now 73 or 75 depending on your birth year. The Social Security Trust Fund faces depletion projections in the 2032 to 2033 range, which means the benefit may be reduced by roughly 20% without legislative action. All of these numbers belong in your income map 3 years out.
Year 2. Solve healthcare before you need it. This is the step that catches more pre-retirees off guard than any other, and the financial consequences of getting it wrong are severe enough that it deserves its own dedicated year in the blueprint. If you retire before age 65, you lose employer health coverage and Medicare has not started yet. That gap, which can be anywhere from 1 month to 3 years depending on your retirement age, needs to be filled by something. Your options are COBRA, a marketplace plan through healthcare.gov, or a spouse's employer plan if available.
COBRA continues your existing coverage, but you pay the full premium, often $700 to $1,500 a month for an individual, $1,500 to $2,500 for a family, plus the administrative fee your employer was previously absorbing. Marketplace plans may be significantly cheaper depending on your income in retirement because premium subsidies are based on income. And if your retirement income is low in the first few years, you may qualify for substantial subsidies that make marketplace coverage genuinely affordable. The specific move that most people miss, if you have been contributing to an HSA during your working years, the balance carries forward indefinitely.
HSA contributions can be made until you enroll in Medicare, and the accumulated balance can be used tax-free for qualified medical expenses in retirement.
A well-funded HSA entering retirement is one of the most powerful healthcare cost buffers available, and the 2 years before retirement is when you should be maxing it aggressively. $8,550 for family coverage in 2026. For those reaching 65 during the 5-year window, Medicare enrollment has a 7-month window, 3 months before your 65th birthday, your birthday month, and 3 months after. Missing that window triggers permanent premium penalties that follow you for life. Mark the date, file on time.
Year 1. Finalize the legal and lifestyle architecture. The final year before retirement is not the time to make major new financial decisions. It is the time to tighten every existing one and build the non-financial infrastructure your retirement actually needs to succeed. On the financial side, finalize your Social Security claiming strategy and your Medicare plan. Lock in your withdrawal order and tax efficiency plan. Run an inflation stress test on your projected budget. What does your retirement plan look like if inflation runs at 5% instead of 3% for the first 3 years? Update every beneficiary designation on every account.
401k, IRA, life insurance, brokerage accounts. Confirm your estate documents are current. Will, power of attorney, healthcare directive. These are not morbid concerns. They are the legal infrastructure that protects everything you spent 40 years building. On the lifestyle side, and this is the piece that most retirement planning content skips entirely because it is harder to quantify, create your retirement vision. What will you actually do with your time? Your answers inform your financial plan because how you spend your days determines how you spend your money.
2 traps financial advisors see most often in year 1. I've saved enough, now I can finally spend freely. And I'll just figure it out as I go. Both can lead to costly, irreversible mistakes. Without structure, spending can creep up silently, especially in the first year when retirement still feels like a vacation. Build a monthly retirement budget before you retire, not after. Build a weekly routine before you retire, not after. The retirees who report the highest satisfaction are not the ones with the largest accounts. They are the ones who designed the life they were retiring into, not just the financial exit from the life they were leaving.
Here is the 5-year blueprint compressed into one paragraph. 5 years out, build your real retirement budget and run the math honestly against projected income. 4 years out, rebalance your portfolio to reduce sequence of returns risk and build your cash buffer bucket. 3 years out, map every income source, understand the tax treatment of each, and begin Roth conversions during your low-income retirement years. 2 years out, solve healthcare completely. Price Cobra versus Marketplace, max your HSA, and confirm Medicare enrollment dates.
1 year out, finalize your Social Security strategy. Update every legal document and beneficiary designation, and build the lifestyle architecture, the daily routine, the purpose, the plan for your time that makes the financial plan worth having. The decisions you make in the 5 years before retirement can make retirement feel a lot more comfortable. Getting them right matters more than almost anything that came before. You spent decades building the number. Spend the next 5 years making sure you know exactly how to live on it.